And then you're going to watch 3 of the movies. You probably already watched some of them already, but it's fun. Inside Job is really the best. It's a great documentary. Lays out the basically the origins of the financial crisis and the criminality by the politicians and the Wall Street bankers and the mortgage bankers and everybody involved. And then the fun one is obviously The Big Short, which is really cool. After you've seen the Inside Job, this one totally makes sense. And then Margin Call is another really good one too. So I don't know, did I hand out the movie review worksheets? Okay, yeah. So you're ready to go. If you want to borrow these, I'll lend them to you, but you got to bring them back. So I can pass them around, or you can get them on Netflix or Amazon or something. Okay. And then what we're going to do today, what I would do is go up to the course website, because we don't have a lot of time. I got to cram like 3 hours of lecture into like an hour and a half. So it's really hard to teach this class when you're doing basically 3 hours a week distributed over the whole week. Okay, and most of you are attending the class right now, which is really great to see all of you here. But I know as we start to move into the semester, you guys are going to get bored with me and probably the people in your team, and you're probably going to want to go to Tahoe and basically drink a keg on a deck, and have barbecue chicken. Okay, so I caught a couple students doing that over the last few semesters. So try to come to class, try to come on Fridays. I'll bring cookies and stuff like that to try to motivate you to come. But if you're not going to be here, tell me you're not going to be here. Okay, it's that when you don't show up and you don't talk to me, I get really, really frustrated. Okay, and I start to get a little angry. Okay, but if you communicate to me and say, I can't come for some reason, I don't care, just make something up, but at least you communicated with me and showed me the respect and the courtesy that we all deserve. Yeah, did you have a question?
We just need one more copy.
Oh, okay. Why don't you just take pictures of it?
Okay.
Okay. And I'll post it to the course website too. Okay. All right, so let's go. I'll let you pull up the course website. Okay. And tell me when you're there. Are you there?
Yeah.
Okay, I'm going to take you on kind of on a test drive. And I'll show you my computer works. I'll show you. Okay. So this website, just like my international website, it's crazy, chock full of all kinds of stuff. So I'll be sending you out announcements. Who Knew It? I haven't checked if it still works, but that was have you ever heard of Linda? There's Linda and there's Who Knew It? They're basically portals for you to go through at your universities to basically get trained in R, Python, pretty much anything. You can get certifications in there too. So that you may want to look at those if you want to beef up some of your skills. But I think it's a pretty cool offering. And then here, this is what I'm going to do is I record all my lectures. And what I'll do is I'll post, after I uploaded it to YouTube, I'll put the link in here and I'll run basically a log of all the lectures so you can go back and listen to the stuff. Or if your aunt, or your grandmother's having a baby, I had that one happen once before. You're not going to be able to make it. You can go to the YouTube video and watch the video. And then here, this part right here, I'm going to build out a little bit. I talked to Bob today at the CME group, and I already handed out the flyers today for you guys to get started. Building, and I would work in teams. Maybe one person trades one day, another person trades another day. See how you do. And I'll be learning this stuff with you. That's that. And then what else do I have here? Oh, here's an energy presentation I did a while back. I actually threw it on as part of the midterm to review. May not do that. And then here, I'm going to take this away because this is the. No. Actually, I'm going to keep this. These are basically the key chapters out of multiple technical security analyst books. If you're going to be a trader, you're not going to use fundamental securities analysis. You might use it in conjunction with technical analysis, but most of the traders that are trading foreign currency, FX, or fixed income, or equities, they basically use a technical analysis. Okay, so I pulled some of the best chapters from some of the books that I have that kind of walks you through how to apply some of these technical trading techniques or technical analysis to make trading decisions, okay? And I'll walk you through some of that stuff again, which will be reviews for the 123 people that will be new, for the other people who did take my class. And then here's the SIE instructions. Again, if you change your mind, it's here. I will follow up with them to make sure it goes through, but if you do it and it goes through, we're in, okay? And then I'll bring Access Insurance here to do a hiring, maybe during the class where we do it through the finance club, and I tell those guys, don't come and tell us about how you were a history major at UC Santa Barbara and partied all the time and got a job with your dad and now you're like making, you know, hundreds of thousands of dollars. It's just come to, you know, you can tell those stories, but come here and hire our students. We'll show up dressed with our resumes, you interview them, you collect the resumes, and you know, you take them on their way if they decide to go. I don't want to waste anybody's time anymore. Okay. Those stories were great, but they get old really quick. And then I already gave you the take-home quiz. Here's the midterm, I'll throw the final up there. The midterm is basically, it's really easy. I give you blue books, you watch me, you know, walk you through how to build a multi-billion-dollar institutional grade real estate portfolio for a pension fund advisor or REIT, and you know, I'll train you and show you how we think and how we, the analytics that we use to basically build the strategy that then is implemented by these large multi-billion-dollar companies to make these implementations. And this just happens to be a real estate example. It could be it's the same methodology for a stock trading company or a stock investment management company or a fixed income manager or a currency manager. It's all the same methodology, it's just applied to real estate. It just happens to be my background. Okay, and then here are some of the course logs from the prior courses. Here's the syllabus. Here's I already handed out the statistical pretest. Here are the resources available here. You don't want to, well, you're going to have to rack your brain a little bit, but I already provided you with some of the resources, so a lot of the information's in there to fill out the pretest. And then you can also use, Google and the internet to be able to get the information. It's all pretty straightforward, but there's a few nuanced questions on the pretest that I will have to walk you through personally to be able to answer, because you wouldn't know how to answer some of those questions unless you've been, a research director or had been in industry for quite some time, building these types of models. And then here, this is what you want to do here, is you want to open up these spreadsheets right here, because what I'm going to do in the amount of time that I have is I want to expose you to the applications, the spreadsheets in which you're going to be building the analytics in this class to be able to build the portfolios and to conduct the technical securities analysis and then roll it all up into a nice portfolio trading system report that you're going to hand in at the end of the class. It's not going to look like Drew's, but it's going to look like some of the, maybe like Mason Lamati's and some of those guys that were really operating at an extremely high level. And then we have this is basically templates I got from, was it Jerry or I forgot who, some of my top students. Basically, this is the portfolio report. These are the templates. Professor Souza, I don't know how to do it on Professor Souza, I don't know how to do the presentation of the passive portfolio there. So you can use these as templates to then update, and a lot of the formatting is already done, so you don't have to do the formatting. You can only improve on this product, okay? So this is what students have done for you in the past. I'm giving it to you as resources to accelerate the development process. So you're not spending all the time developing it, you're spending all the time putting in the data, doing the analysis, and then presenting the results, okay? And that's how it usually is in other companies. And then here's your, the Word documents, which are the solutions to all of your homework problems, all right? because I want you to learn how to solve the problems the right way, okay? Instead of trying to figure it out and rack your brain and waste your time. I'm giving you the answer so that you know how to learn it right off the bat the right way and move on and learn more, okay? That's kind of how I did it in my undergrad, especially in accounting. Accounting is so brutal, and I wasted so much time trying to frickin' figure those problems out that I was never able to really finish all the problems and prepare for the exam. So when I changed my methodology to study problems and answers and memorize basically 100 problems and answers, when I walked into the exam, I knew, even though the question was different, I knew the structure of the problem, and I knew how to basically plug in the new numbers into the problem. And even though I got the problem, the answer slightly different, I had set up the structure of the problem, so I got at least 70 to 80 and maybe 90% of the points because I set it up, and I might have done some kind of dyslexic transformation of a 6 and a 9 that made me be off of my answer. But the professors were looking really for structure. And then here are the Excel spreadsheet templates. And in the homeworks, I ask you to go to these Excel spreadsheet templates and look at them and analyze them. And then print them out as though you were going to give it to a manager. Okay, so you don't just like print all worksheets so it comes out all totally messed up. You got to kind of format it and then print it out so it's either in landscape or in portrait on multiple pages with repeating rows or something, so you're going to have to work with the Excel. But at least you'll have these as templates for yourself, and I would download these and archive them, but also getting to know how to navigate Excel and then how to print from Excel and work within it. Because what's going to happen is you're going to walk into a shop and they're going to say, hey, we've already developed a lot of the Excels. Go audit them, right? The first thing you're going to do is audit the Excels and make sure that all the formulas are correct. Because you don't want to get a messed up Excel spreadsheet that you're running the analysis and pump out the results and you present it and they're wrong because somebody accidentally hit a key and wiped out a formula and you didn't notice, or there was a transformation in the cells that they were referring to. So you got to kind of look at the cells, look at the structure, and then play with the numbers. Okay? But I give you all of the templates for the homeworks to answer. And then here are the Excel. These are templates. Here are the Excel solutions. Here's all the PowerPoint presentations that you're going to use next Friday for the teams that are going to be presenting from the chapters. What I would do is use the PowerPoint presentations, study the chapter, because you got a whole week to basically do it, study the chapter, work with your team, edit the PowerPoint presentation down so it becomes more succinct, so you can present it in 12 minutes instead of 25 minutes, because you didn't prepare, so you wasted our time sitting up here reading every single word on the PowerPoint presentation. That's what happens every semester. I got a few people that show up, yeah, I'm ready to present the chapter. They get up, they start reading from the chapter, and they take up all of our time. The total waste of time. I'd rather have you say I'm not ready, and I need another week. And by the following week, we'll be prepared to do the presentation. Okay? So it's more quality than anything. And then down here, I also added in the summary notes, the instructor summary notes for the chapters. So you can burn through those. Those are like 2-3 pages, which is great. And then, what do I have? Investment stock portfolio template. So there's a template, because you're going to do presentations. You're going to do your passive portfolio presentation. You're going to do your active, and then you're going to do your target at the end. And all three portfolios you're going to present at the end. Did you have a question? Did you have a comment?
Yes. Would you like us to put like the word problems, like the solutions with the slides, or just the slides themselves?
No. No problems. The problems are going to be separate. The problems that I handed out, you're going to, on Wednesdays, you're going to come in, you're going to grab a highlighter, and you're going to put them up on the board, and then you're going to present them. And then on Friday, you're going to come in, you and your teams, and you're basically going to present the chapter content. And then on Mondays, I'm going to come in and I'm going to lecture. Okay, so it's lecture, problems, presentations, lecture, problems, presentations. Okay, so it's a pretty good rhythm. And I think, oh, and then if anybody's interested in real estate, I got a whole section down here on real estate investments. So if anybody's interviewing for a large brokerage firm in their investments or acquisitions, or property management positions, or their mortgage financing division, there's a lot of resources down here that I could help you with to, prepare. So you know what you're talking about when you go into the interview. Okay, so what you want to do, did you guys pull up the Excel spreadsheets? The first one you want to do is pull up the first one in your team. So what you need to start doing, if I can find it right here, this one. So let's look at A. So A, here's the template. And this is a pretty simplistic passive portfolio that you're going to build. So you need to sit down maybe over the weekend or something and talk to your teammates and say, what kind of portfolio are we going to construct? Is it high return, high risk? Is it low return, low risk? Is it moderate return with moderate risk? Is it a portfolio that we think that we could construct that would beat the S&P 500 consistently over time? And then back test it. So you're going to need to figure out the mix of the portfolio. How much is going to be large cap stocks? How much is going to be mid cap? How much is going to be small cap? You got to figure out what are the sector allocations. How much is defense or consumer products or tech or whatever? You got to kind of figure that out. Okay. And then what I did is I built this isn't it, but I built a portfolio of just tech companies that I knew. So it was 100% tech, mostly large cap, mid cap. There was no, I think I did have Alibaba in there too. So some major, maybe tech companies. And then what I did is I went here to this page right here, the master target portfolio. And there's instructions down here on what you're doing. So first things first, let me kind of walk you through this. So here are the 25 companies. This is not what I built, but I think it was Jerry that built this. Oh no, it was Nick, Oscar, and Daniel. So these companies are categorized by sector. Okay, so obviously this is tech. Here's defense. This is healthcare and drugs. This is consumer products, online entertainment. Starbucks, and then we had some financial services here. Okay, so then this is all. If you fill all of this in, it flows through to the other worksheets. So don't start playing with the worksheet because you're going to mess everything up, and then you're going to have to redo everything. So just follow the instructions, and you won't waste your time. But you got to put in the company's name. You got to number it. You got to put in the industry that they're in. You got to put in the ticker symbol. Then over here, this blue column right here, you are going to put in, and you can decide what you want to put in here. It could be, have you ever heard of an exchange traded fund? Exchange traded fund, ETFs? ETFs? Yeah. Yes. Smart beta. You should be like Googling this stuff, writing this stuff down, taking notes, all that stuff. Basically, ETFs is what we're really building here. Are basically factor driven. Your allocations that you come up with here are not driven by securities analysis and portfolio optimization, which we will do later. It's basically based on some factor weighting that you've come up with. So this, what they used was market cap. And this would be total market cap, the value of both the debt and the equity, or it could be just the value, the market cap of the equity. And you put so this is a market cap weighted portfolio. Okay, it's a market cap weighted portfolio. You could use sales, you could use revenues, you could use earnings, you could use other factors, maybe population by geography, or I don't know, something. But market cap or sales or revenue or earnings are probably the top three that you would use. Most people use market cap because it's clean, and you can get it really easy from Yahoo Finance. So you plug in the market cap, and what it does is it sums it all up for the 25 companies, and then divides it back to give the weights. Okay, so if I take the total market cap, and then I take the market cap for JP Morgan Chase, JP Morgan Chase is 4% of the portfolio. Okay, so that's it's just a market cap weighted. And then these are all calculated here. They put the betas in here. The beta for the company times the weight is going to give the weighted beta. You sum it all up and you get the portfolio beta. Okay. And if you're using mostly large cap stock, am I talking foreign language here? I mean, you'll be okay. If they're very large companies like JP Morgan and really big companies like Apple and stuff like that, what do you think their beta is? To what? What do you think it is? Yeah, exactly. It's about the market. It's probably about 1. If there's small cap, mid cap, high tech, then the beta is going to be higher. Okay? And then when you go international, a lot of the international stocks in the portfolios that are built, actually their betas are really low. The returns are low, but their betas are super low. And actually, we've even done some fund-to-funds international portfolios where we actually had a negative beta for our portfolio. International, yes, pretty bizarre, but interesting. So you put in the market cap here, and then what you do is you put in the stock price, okay, as of January 1st, okay? So remember that. So in this target portfolio, you're going to put in the stock price as of January 1st, okay? And then now you're off to the races, all right? So now what we do is we go to the 1-year back test, all right? And what happens is we carry over, and this is, Chiquino, I'm sure if Stephen Parlett was here, you'd be going, Professor Souza, you've done some things that I wouldn't do this way. But this is a really simple model to get you guys to start thinking how to construct and adjust portfolios. So that's really the objective. So what we do is we take these, let me finish this. So I got the percentages here, okay, the weight of the portfolio. I'm giving you a hypothetical $1 million, okay? So basically you take that percentage, JP Morgan, the 4% times the 1 million, that gives us 42,154, okay? We take that amount divided by the stock price and we get the number of shares that we're going to buy in JP Morgan, okay? So then what I did, just to keep the model simple, is I just carried over the number of shares, okay? And then what we do is we multiply the number of shares times the stock price, okay? And that's going to give us the total value a year ago. And then we sum that up. So a year ago, this portfolio was worth $799,000, okay? And then what you do in this 1 year, you're going to January of 2018, okay? And then you basically go to the third sheet, the back test 2, 3 years back. You put in the share prices from January 2016, 17, 18, 19, right? So you do that, and then you go back to January, what is it, 14, right? So 19, 18, 17, 16, 15, 14. So then you put in January 14 here, and then you go back to January of 2009, right? And you put in the price there, okay? So then what you do, what it does is it calculates your average annual compound growth rate, okay? So what did the portfolio do over the last 10 years? Keeping the share mix constant, okay? So this portfolio, there's the average annual compound growth rate equation. And you can't just take the change in the value of the portfolio over 10 years and then divide it by 10 to get the average. That's not how you do it. You gotta calculate it using the average annual compound growth rate equation. And then you gotta calculate the average annual compound growth rate for the S&P 500, okay? And plug that in there. So this portfolio did 13.4% per year over the last 10 years. The S&P 500 did 7.4%. Therefore, the alpha in basis points, the alpha, how many basis points are there in 1%? How many basis points are in 1%? How many basis points are in 1%? How many basis points? I'm just going to keep asking until I get the answer. It drives my students crazy until they go find the answer. How many basis points are in 1%?
100.
100. You may want to write that down. Okay. So basically 13.4 minus 7.4, or 1,340 minus 740 basis points gives you 604 basis points. So basically this portfolio outperformed the benchmark by 6.04% or 604 basis points. Would you buy this portfolio? If I was to market to you as a retail client, as an exchange traded fund or a mutual fund or a single account, would you buy this portfolio? Would you invest in it? Yes. Heck yeah, you would. And if I could outperform the market by 6.04% per year over time, or 604 basis points consecutively over time, are they going to give us money?
Yes.
Yeah, I'm going to get assets under management. And what if I get, at one point, I get $1 billion of assets under management, and I charge one point fee, 1 percentage point fee on $1 billion. How much do we take in per year? $10 million. Okay, $10 million bucks. So I got to pay Goldman Sachs $5 million. We get to keep $5 million. I got myself, and I got 4 analysts with me. I pay myself $1 million. I pay each of you $1 million too. So we all make $1 million each. Okay, net of fees and expenses and splits that I would give my broker dealer or my bank. Can you live off $1 million bucks a year? Yeah, totally. So that's the kind of scale, and that's the kind of magnitude that we're talking about here now at this point in time in history, because you're not just learning finance anymore, you're inventing product and process. It's totally different. FinTech, we're all basically product and process managers, okay? Developers, we develop product, we manage projects, we program manage, we project manage, we product manage, we product develop. That's what we do now, okay? It's totally different. You're not studying finance to basically, work with the accounting department to produce reports for, annual reporting. What we do is we develop products, okay? And it's either individual security products or it's going to be portfolio products that then we're going to go market through our distribution channels, our marketing distribution channels, to get assets under management, to be able to generate fees, and then we basically benefit from it. And before, we used to have a portfolio manager and maybe 5 analysts. Now I can run a multi-billion-dollar fund with me and maybe two analysts, okay? Because the technology now, and a lot of it's being automated with AI and machine learning, okay? So that's basically the passive portfolio, okay? And what I would do is I would start working with the spreadsheet, get into your teams, set out a portfolio style and a portfolio strategy, start identifying some of the stocks, come up with a industry sector mix, find the companies, that would fit, into those buckets, and get ready to back test, and forward test the portfolio, because then it's going to be rolled up into a PowerPoint presentation, and you're going to present it. Okay, you're going to present with the style, what the mix is by market cap, what the mix is by sector, what the top holdings are in the fund. And then you're going to give me a 1, 3, 5, 10-year back test, and you're also going to give me a forward test. Because what we can do now, and I already have the forward test worksheets set up, what we do is, since we already have January 2019, the first forward test worksheet, we basically do it as the end of March, so the first quarter. So I do the percentage change on the portfolio from January to March 30th. And then the second forward test is going to be from January 1st to June 30th. And then the third forward test is going to be from January to September 30th. But we can still put those numbers in and just guesstimate where we think the stock prices are going to be at the end of September. Because we already kind of know what the run rates are, right, over the last 9 months. pretty much, or 8 months. And then we can also, for the forward test number worksheet 4, we can just plug in what we think the prices are going to be in December. And what we'll do is we'll plug in right before the end of the semester, we'll plug in what our forecast prices are for the stock. So now we have 1, 3, 5, 10 back tests, and we have 3, 6, 9, 12 forward tests. So now we can go to our investors and say, yeah, we back tested and forward tested it, and we continue to outperform the benchmark by X basis points. So let's go out and raise institutional and retail capital. Let's do an ETF around this. Let's do a mutual fund. Let's go to CalPERS, CalSTRS, Ohio STRS, Michigan, New York. Have them give us a couple $1 billion, and we'll manage their money using this portfolio strategy. Okay. If you're having a hard time following along with me, that's why we got the video, and I will be talking like this throughout the semester, so that by the end of the semester you'll totally get it, and you'll be able to replicate the way I talk, because that's how we talk. Okay. If you watch Bloomberg and you listen to, I'll have Stephen Parlett come in, and then you listen to how we talk. This is how we talk. Okay. So you have to kind of learn the language so that you can participate in the conversations, so you can be part of the development team and the management team and the management team. Okay. All right. So does everybody have enough information on that one? Okay. Now let's go to the second one. And how much time do I have? Because I talk too long.
20 minutes.
Okay. So this is the second. So after we do the passive portfolio, we do the presentation, we start working on the active, or the active approach, which is a little bit more complicated, or actually a lot more complicated. By that time, your brain has been, being rewired. So here we have the same 25 stocks. I got the standard deviation, the variance, the correlation, the covariance, and then the mean and the median annualized returns. Okay, over the last, I think it was 5 years in this case. And the problem is that if you do quarterly returns, or year-over-year quarterly returns, you don't have a lot of data points. So what I did was I took the annual percentage change, right? January 1st, 2019, January 1st, 2018, and did the percentage change. Then I did January 2nd, 2019, year-over-year change, January 2nd, 2018. So basically I have like over 1,000 return distribution, which is huge. So I manufactured basically annual returns on the stock by using a year-over-year daily change as the time interval to manufacture the data, okay? Which since the sample sizes are so big, the returns start to approximate a normal distribution. So it's pretty cool. And then what you do is you're going to forecast 2019 returns for the individual stocks, okay? And that's going to be the basis of the analysis. And all of these, everything you see is all linked, okay? Everything is, this is more of a show page. There's no inputs here. It's all being pulled from someplace else. And then this is your covariance matrix between the 25 stocks. Again, it's all programmed. I've already done it, okay? I'll walk you through more of the complex procedures that you need to go through to get to where we want to go. And then here, what we do is you're going to have to add in the solver, okay, in Excel to run the quadratic optimizations, okay? And what you're doing when you're running the quadratic optimizations is you come up with a return on the portfolio, and then the optimization procedure basically runs the analysis off the covariances and kicks out basically the portfolio weights, okay? And then you're going to copy those weights over here, and that's going to be your first iteration. So we were forecasting that Apple stock was going to generate 22% rate of return this year. When we ran the optimization, since the 22% was the highest of the 25, it basically, the optimization basically said put all of your money in Apple stock if you want to get a 22% rate of return. If you want to get a 15.7% rate of return, we ran the optimization and it kicked out these weights. So we run basically 15 optimization iterations. And then we look at the return to risk ratio. So it's the mean return on the portfolio divided by the standard deviation will give us the return to risk ratio. I'm supposed to be using the Sharpe ratio, but this is more intuitive. Conceptually, there's probably slight error in it, but it just makes more sense. So this portfolio here that we have identified is the one that provides the highest return to risk. Okay, so this is the portfolio that we want. Okay, this is the one that if you do the capital allocation line, efficient frontier, remember this? That's this one right here, is that portfolio right there. So it's the one that's going to provide you, it's the highest portfolio that gives you the highest return to risk ratio. And then these portfolios here are inefficient portfolios. So we don't want those. We can short those, but we're not going to do that. And then we're going to have, there's Apple over here, and then there's all the other portfolios here. We're not going to jump off the efficient frontier on the capital allocation line because we're not using margin in the account. It's just a straight portfolio. So that's the one we want to pick. So that's the best one. Then what we do is we go back, we take these weights right here, and we go back to our static passive portfolio worksheet, and we basically manipulate these market caps to replicate those weights, and now you already have the back test and the forward test done for your active portfolio. Is that awesome?
How would that margin reflect, like if you were using a margin?
It would add more volatility to it, but it would increase the return significantly. Okay. I just didn't have time to program that in, because there's already so much content here. I was just trying to set a solid foundation, to be able to do this kind of stuff. Okay. And then ideally at the end, this is what it's going to look like. There's all these instructions in here. It just walks you through everything. I don't just throw it at you and say, hey, go do quadratic optimizations, active portfolio strategy. So this is what it looks like. Here's your capital allocation line. That's one optimization procedure. Then you run the 15 optimizations and it traces out the efficient frontier. There's that right there. So that's kind of how it should look. Okay, if you did it right, and if you're using, the right stocks that have normally distributed returns, it'll look like that. Okay. How am I doing on time?
15.
Okay. I'm just taking you through this really quickly so that you can get it in your brain and start noodling it instead of saying, oh, now it's time to do, the active portfolio. It's like, well, I've never seen it before, Professor. Well, at least you've kind of seen it now. Now this sheet, this is number C, which is the intrinsic valuation calculator. Anybody know Dakota Armour? Anybody remember him? Yeah, he programmed this. So he did this, which was pretty amazing for him to do. We actually spent one whole semester building out all of these spreadsheets so that you guys could use them, okay? Which was pretty awesome. So this is kind of the master sheet, company input, and then these are summary pages here, stocks 1 through 6, 7 to 12, 13, 18, 19, 24, and number 25. And then you have the individual stock worksheets, okay? So here, this is just this pulls from over here, but this is really where all the stuff goes down over here. Chiquino, you want to be looking at this because this is what you're going to be using for your investment group. So I got the 4 intrinsic valuation methodologies here: perpetuity, Gordon growth, multiple approach, and discounted cash flow. We are using an 8, 9, and a 10% expected return or required rate of return by the investor. Here, those are all constant across all the 3. And then what we did is we did some research and we found some multiples for Apple and basically put in a sensitivity range of multiples. And we're going to use the the midpoints on everything, but we ran sensitivities across the different valuation methods. You're not gonna use 2017, you're gonna use 2018 earnings per share, okay? And that'll be the base. And then you're gonna forecast here based on the DCF model, you're gonna forecast what the earnings per share is gonna do from 18 to 19, 19 to 20, so you're gonna put in the forecasted earnings per share growth rates, okay? And then obviously you gotta grow it out one more year. This is all programmed, so remember in my 123 class, I was making you do all this stuff by hand. Well, now we have it all programmed, okay? So what we're gonna do the forecast, right? You're gonna grow out the earnings per share one more year. You're gonna apply the Gordon growth model based on some terminal discount rate, some terminal growth rate to get the terminal value. You're gonna add the terminal value to the last year, to the holding period's cash flow. And then in this case, under an 8% scenario, you're gonna divide it by 1.08. Okay. And then what it does is it discounts it back at the 3 different discount rates and comes up with the intrinsic values using the discounted cash flow, multiple approach, Gordon growth, and the perpetuity. Then basically those values, we have basically the weighting schemes, right? So we gave perpetuity 5%, Gordon growth 5%, multiple 35%, and discounted cash flow 55% of the weight, the scenario weights. Then we're going to calculate the weighted prices for each, weighted values for each of the approaches. We're going to get the weighted share prices, add them up, there's your intrinsic value. Okay. So then I'm going to compare our intrinsic value to the current stock price. We're expecting Apple shares, where's Apple right now, like 150 or something like that? What is it? That was it, 213? Yeah, so let's say it's like 215. It's currently at 215, but we think it's going to go to, 230, right? What's the percentage change on that? Or maybe we think it's going to go to 250. So what's the difference between 215 and 250? What's the percentage change? Can you calculate that? Yeah, just take 250 divided by 215, and what does that give you?
16%.
1.16?
Yeah.
Yeah, so that's 16%. So we think that Apple stock is going to go up 16%. So you're going to do that for all the stocks, and then you're going to rank them from premiums to discounts. And we're going to overweight, the final portfolio, the target portfolio, where we reconcile the active and the passive. We take the analysis, and we're going to overweight the stocks that we think are going to go up the most based on the premiums, and we're going to underweight the ones that we think are going to underperform, are going to be either trading at a discount in a year or something like that. Okay. So this thing is totally cool. How much time do I have?
Time.
And you're going to need to have a portfolio manager. You're going to need to have a fundamental securities analyst to do this right, and you're going to need a technical analyst, securities analyst too. So it's specialist by specialization, okay, to do it right, because it's too much for everybody to do everything, and then you guys can teach each other. And then the last method is the moving average crossover system. It's a technical trading system that I developed, and we've been back testing it for at least the last 2 years. So what you want to do is go up to stockcharts.com. Stockcharts.com. You need to write this stuff down. Okay? You should be writing notes. That's what I would do. So what's Apple stock? And you're going to do this for all 25 of your stocks. So what's Apple stock? What's the ticker?
APPO.
APPO. AAPO.
Yeah.
Oh boy. Okay. AAPO.
Yes.
Thank you. Okay, and then boom, it's gonna give you, so here's the chart that it's gonna give you, all right? So what you gotta do for every one of your charts for this exercise, is you go down here and where it says fill the chart, click on that and go to 3 years, because we're doing a 3-year back test period on this trading system. Okay? Everybody following along? Okay? Then you go here where it says simple moving average and you take that to 10. And then the second simple moving average, you're gonna do 30. Then you're gonna go to the next one and you're gonna do simple moving average again, and it's gonna go 50. Okay? And then you hit update right there. And bam, it gives you a 3-year chart with a 10, 30, and 50-day moving average crossover system. And the technical trading system, and one of my students that I taught this to, and he's been trading this since like 2007. No, shoot, 1997. He's been trading this since 1997. He's made a ton of money off this thing. This is just a simple buy-sell trading system, okay? It's rules-based. It's based on 10, 30, and 50-day moving averages, okay? So here's the 50-day right here, okay, which is a very smooth line, boom. And then the 10-day is the blue, and the 10-day is gonna be more volatile. So it's gonna move above and below the 50-day more often. But when that 10-day crosses the 50-day, that is gonna be your sell alert. So basically you program to basically alert you that, oh, the 10-day just crossed the 50. And then when the 30-day crosses the 50, right there, that's gonna be your sell signal. And you're going to, you're gonna sell this stuff. Okay? And then as you can see here, the 10-day crossed the 50 right there. That's gonna be your buy alert. And then when the 30-day crosses the 50, that's gonna be your buy signal. And that's when you're gonna buy the stock. Now what happens is you can see the 10 and the 30-day stayed above the 50, so you're in a holding pattern, you're holding the stock. As you can see, you sold it here, you sold it here, you bought it back here, you sold it here, you bought it back right here. It looks like you sold it there. There's some noise in there. You bought it here, and then here, as you can see, the 10 and the 30-day never crossed the 50. The 10-day may have crossed the 50, but the 30-day didn't cross the 50. So there wasn't confirmation. It was a false alert. So you rode Apple all the way up to here, and then you sold it here, you bought it back here, you sold it here, you bought it back here, and you're probably riding it up right now. So if you just stick to this this trading system, you basically go back to your profit loss. And you plug in, your shares, your exposure by shares, and then you go back over the 3 years and you start plugging in what you bought it for and what you sold it for, based on that trade. So we lost a little money here, but we bought it at this, when the 10 and the 30-day crossed 30-day, we bought it here and we sold it here, so we made that profit. So we basically put in the trades going back 3 years. Let me just finish this and I'll answer the question, because I'm running out of time. So here, it basically sums up what your trade profits were over the 3-year period. This portfolio, based on this trading system, netted, based on $1 million, netted $242,000 in 3 years. They did about $80,000 a year on average. The first year, they generated 52,000, then 94, and then 95,000 in the third year. If you implement this trading system within your self-directed IRA, your retirement account, if you implement this in your retirement account, you don't pay any capital gains taxes on the trades, okay? So the money accumulates in your portfolio, tax deferred, over the 30, 40 years that you've been implementing this trading system. Now, if you do this, you're gonna make, a few $1 million, okay, over a, 30, 40-year period. Plus the money that you invested in the portfolio itself, the underlying, you'll probably get another $3 million. Just getting a 13% rate of return on your your portfolio that you built. So you're looking at potentially, $6 million in 40 years from now. Can you live off that? Can you retire? Can you send your kids to Harvard? Stuff like that. Yeah, so if you implement these strategies and you stick to your program, you're gonna be a multimillionaire. If you don't, then somebody's gonna steal your money, or they're gonna manage it for you at a subpar or a suboptimal level. Okay? So it's up to you to decide. If you believe in this stuff, I believe in it, and if you want to implement it. Okay? So that's basically the, how am I doing on time? I got 1 minute?
Yeah.
Okay, and then the last is just a spreadsheet of the companies with the valuations. You're sorting from premium to discount, and then the last spreadsheet is basically the financial ratios, the key financial ratios that you can use to basically quickly do some fundamental analysis using financial statement or financial ratio analysis as the fundamentals. So that's basically the class, okay, and what we're going to do. So that's going to be the application level. We'll review some of the stuff from 123. You're going to follow the book. You're going to present the chapters. You're going to do some problems. And I think between all of that stuff, again, it's basically a master's program in finance kind of crammed into a semester. So you'll have all the tools and techniques that you need to do whatever it is you want to do. Okay, either for yourself or as a career. Okay. That's it. David? What was your question?
Just curious.